SIP is the best investment strategy. Stop. Before you add another rupee to your SIP, you need to watch this. Every finance influencer, every bank ad, every well-meaning uncle at a family dinner, they all say the same thing. Just do a SIP and your future is sorted. I am here to tell you that this advice is incomplete. Not wrong, not useless, but it is incomplete. And that one missing piece is costing you lakhs of rupees. Here is the hard truth. SEBI's own data shows that 97% of SIP investors quit before completing 5 years. 97%, that's huge. Which means almost everyone who started a SIP, just like you, stopped it. Not because they were lazy, not because they didn't care, because nobody gave them a strategy that actually works when the market crashes. In the next 12 minutes, I'm going to show you what that strategy looks like, with 30 years of real market data. And once you see the numbers, you will never invest the old way again. Let me tell you about Rahul. Software engineer, mid-20s, finally earning well. One fine day, he decides, okay, I am going to be responsible. I am starting a SIP. 10,000 rupees a month, Nifty 50 index fund, direct plan. He did everything right. Then comes April 2025. The market falls. His portfolio is down 18%. His girlfriend looks at his phone and asks, "How is the investment going?" And Rahul suddenly really needs some chai. Now, this is not Rahul's fault. This is how human brains are wired. Behavioral scientists call it loss aversion. We feel the pain of a loss about twice as intensely as the pleasure of an equal gain. When your portfolio goes red, your brain screams danger, even when the logical move is actually to buy more. SEBI data shows that more SIPs are being started every year, but SIP discontinuations are growing at 4 times that rate. People do not lack intention. They lack a strategy that works with their emotions, not against them. So the fix is not to abandon SIP. The fix is to upgrade it. Now, let us look at some actual numbers. Business Today analyzed 30 years of Nifty 50 data from 1995 to 2025, comparing 3 investing strategies. The total amount invested across all 3 is the same. First strategy, simple monthly SIP, 10,000 rupees every month. Second strategy, lump sum on dips only, 1,20,000 rupees once a year when Nifty falls 10% or more. Third strategy, hybrid, SIP plus lump sum on dips, 5,000 rupees per month SIP plus 60,000 rupees lump sum on dips. Now look at that carefully. The XIRR numbers are close, but the corpus difference between pure SIP and the hybrid approach is nearly 52 lakh rupees. 52 lakh. That is a car. That is 2 to 3 years of a child's college education. All from one simple upgrade to how you invest. The hybrid SIP plus lump sum on dips strategy gives you approximately 52 lakh rupees more in final corpus compared to a pure SIP, with the same total money invested over 30 years. And here is the psychological magic of this approach. When the market falls, the hybrid investor does not panic. They get excited, because a falling market is their signal to deploy more money. Red market equals opportunity, not fear. Opportunity. Here is the actual strategy. 3 ingredients. Simple to understand, powerful to execute. Ingredient 1. Your SIP. Never stop it. The entire strategy rests on a continuously running SIP. Market up, market down, market sideways for a year. Keep it running. The Association of Mutual Funds in India's analysis from 2013 to 2023 found that SIP investors bought their units at costs 18 to 22% lower than the average market price, simply because they kept investing through every dip. That is rupee cost averaging doing its quiet, powerful work behind the scenes. Do not interrupt it. The next one, ingredient 2. Step up your SIP every year. Before that, quick question. You were investing 10,000 rupees in 2016. Are you still investing 10,000 in 2026? If yes, did your salary also not grow in 10 years? Because if it did not, we have much bigger things to talk about. Just kidding. What I'm trying to say here is, increase your SIP by 10% every year. 10,000 becomes 11,000, then 12,100, and so on. This step-up SIP gives you better returns because your contributions grow larger during the typically bullish later years of the market cycle. You invest more when the market deserves it. Now, the last one, ingredient 3. Build a dip fund for lump sum opportunities. This is the secret weapon. Keep a separate small corpus, equal to about 3 months of your SIP amount, parked in a liquid fund or ultra-short-term debt fund. This is your dip fund. It is not for emergencies. It is for opportunities. Here is your trigger rule. Write this down. Nifty falls 2 to 3%. Deploy 3 times your monthly SIP as a lump sum that month. Nifty falls 5% or more. Deploy 5 to 6 times your monthly SIP as a lump sum. Example. Your SIP is 10,000 rupees. Say Nifty drops 3%. You add 30,000 rupees as a lump sum. Total invested that month, 40,000 rupees. You just bought a lot more units at a lower price. Now, if Nifty 50 is trading around 24,000, approximately 9% below its January 2026 peak, the market is presenting exactly the kind of environment where a disciplined dip fund deployment can be powerful. And here is the beautiful psychological shift this creates. Instead of dreading a market fall, you start looking forward to it. Because a red market means your dip fund gets deployed. You have turned fear into a structured action. Let me step away from numbers for a moment and talk about something more important. Your behavior. The biggest risk in investing is not the stock market. It is you. When markets crash, human brains do the worst possible thing. They sell, or they freeze and do nothing. Both are damaging. But if you already have a written plan for what to do when markets fall, there is no panic, no paralysis, just calm execution. From 1995 to 2025, Nifty 50 went from roughly 1,000 to over 24,000, a 24 times return in 30 years. But most investors did not get that full return because they kept stopping, starting, panicking, and quitting at exactly the wrong moments. The best investment strategy is not the one with the highest number in a backtest. It is the one you can actually follow for 15 to 20 years without losing sleep. So here is the bottom line. Let me say it clearly one more time. SIP alone gives you 12.48% XIRR. Solid, respectable, good. SIP with Step Up gives you slightly better returns because your investments grow with your income. SIP plus Step Up plus a smart lump sum on dips gives you the best combination, both in terms of final corpus and in terms of keeping your psychology intact through every market cycle. Did this video change how you think about investing? Hit subscribe and like. It helps more people find this. Subscribe for more honest, data-backed personal finance content. See you in the next one.